In this section, we get into the execution, how you enter, how you exit, the various setups that give you good entries, and the conditions and rules which give you good exits. So here we basically tie everything together and get into the practical aspects of actually trading the market based on everything you've learned. And to kick it off, we're going to start with something that is probably one of the least understood things in trading. One of the things that has probably the most myths and incorrect facts surrounding it. This particular thing, I know for a fact that the majority of so-called gurus or educators out there teach this particular thing wrong and teach it in a way that's going to make things the least efficient for you in terms of entries. So what we're going to teach you here is very important, and it's one of the keys to being able to have a strategy with a sustainable edge. Okay, so let's start off with a quick question. Based on whatever you might know or have been taught about trading, what do you think the number one rule is for good entries? Alright, if you were to have rules about entries, what do you think would be the number one rule? Think about that. Pause the video if you have to give it some thought, and then we'll get into it. Okay, so I hope you've given it some thought. And here is our number one rule for entry. And as you see, our number one rule for entry is that you do not wait for confirmation. Now, this might go against everything that you've been taught, or maybe you haven't considered the whole subject before and knew that there were good rules to entry. Regardless, this is something that you really have to understand and apply in your own trading, okay? And the best way to explain the whole issue and the risks of waiting for confirmation and the benefits of not waiting is to just jump into the charts and show you. So let's do that. Here we are in the charts to take a look at a specific example so you can understand this rule. We're assuming that we're trading this particular day, okay, on the right. And coming into this day, we had done our pre-market prep and we had identified this particular area as a support zone that's important. Of course, we would have identified other support zones too, but I'm just going to use this as an example now. And this is a support zone, of course, because this is the high volume node of the previous day, right? And this is the thickest part of it. So we've defined our support from 1410 to 1408.75. So it's about a 1.25 point support zone. Okay. And so on this day, we open up and we try to test higher. The sellers reject it and they come down. And then they finally come down to test this previous day's support zone. All right. Now, here's what most trading teachers would tell you to do. They would tell you that, okay, if this was a good support zone, then you wait for the price to get here and display some sort of setup, and we're going to get into the setups, but let's assume, and we'll get into it, that one of the setups is some kind of short-term exhaustion, and you see it on this particular bar. Okay, so on this big down bar, by the end of it we see some kind of short-term exhaustion happening at this support area. So that's a good buy setup. All right. Well, what most trading teachers will say is that, okay, now you have your setup, but now you need an entry trigger. All right. So they go, okay, setup is different than an entry trigger. And just because you have your setup, it doesn't mean things are going to trigger. So what they would need for an entry trigger to get you into this trade, as this setup has shown up, is what? Confirmation. Okay? They basically tell you, well, you have this setup, but you're not sure if it's actually going to work out. And the best way to be sure is to wait for confirmation. So they tell you that once it hits here, you need to see some kind of strong bar the other way to the upside to confirm that this area is holding. And once you see this strong bar, then you buy, all right? And that's the time you get into the trade. Now, of course, that seems logical, all right? It seems very logical to wait for something that confirms, yep, this zone is holding, let me get into this thing. And it seems that your odds of this trade working out will actually be higher because you've seen this confirmation. All right? So let me break this down for you and show you why this logic is so flawed and all the drawbacks of waiting for this kind of thing. Okay, so assume that you're actually going to trade this setup. All right? The first question I have for you is, if you were entering on this setup, regardless of where you're entering for now, regardless of whether you wait for confirmation or you don't, where is a logical place to put your stop? Have you identified what you think is a logical place to put your stop? Okay, well, and this is something that you probably know, but the vast majority of the time, if you have some sort of support or resistance zone, the most logical place to put your stop is a bit below it in the case of support. So somewhere around here. Why? Because if price were to trade all the way down to somewhere like 1408, that means it just traded right through this whole support zone. And the fact that it traded through this whole support zone would be telling you that the sellers are in control. The buyers here were not able to hold the price, and you should be getting out because you shouldn't be buying anymore. Now, does that mean if price comes through here that it has to just keep shooting down and it can't bounce? Well, of course not, no. But all it means is whether this was a fake breakdown and it's going to pop back up or not, you can't take the risk of sticking around to see. You just have to take your quick loss and get out. All right? And at least on the most immediate time frame, this support or resistance zone would have been invalidated and your long bias would be invalidated, so you'd get out. All right? So let's assume that, you see here the volume, the edge of the volume kind of tails off right here, and then it just becomes nothing below 1408.5. So let's assume that a logical stop would be around 1408. That if price hits 1408, this zone has pretty much broken and you want to get out. Well, let's look at this. Let's look at this camp of people and educators and gurus saying that you should wait for confirmation. All right? So assume price hit here. If you waited for confirmation, you would be entering on this bar, because they would be basically saying, look, you need to wait for a bar that shows strength, a nice wide green bar that opens near its low and then closes at its high. And so, this bar does that. And so that would be your trigger off this setup. All right? And so that bar closes at 1411.5. So let's just assume you were able to get 1411.5 as an entry, okay? You were able to hit buy, and usually you would probably be filled at 1411.75, but let's just be conservative here and say that you got filled at 11.5. Okay. Now, if you want to put a stop at the logical place, which is around 1408, okay, how wide is your stop? Well, from 11.5 to 08, that's 3.5 points of stop, right? So you have 3.5 points. Now, what's your profit target? Well, like we've mentioned before, you should rarely ever have a profit target that's less than 1-to-1 in terms of reward to risk, right? And most of the time you should be shooting for at least 1.5 or 2-to-1 or more. But let's assume in this specific instance that this is such a high odds setup that you think your accuracy on the setup, you've seen it before, and it's about 70% or so, and 1-to-1 is good for you. All right. Well, you have a 3.5 point stop. 1-to-1 would be 3.5 points higher, and so you're looking at 1415. Well, it doesn't take much to see that If that's the case, what ended up happening here is that you couldn't even reach your profit exit, and this thing ended up tanking back down. And if you had moved your stop to break even, which would be like way up here, 1411.5, you were taken out right away. And if not, you had a complete loss. Okay? Even though this thing bounced off your support zone by 4 full points, you had a loss. Or at least definitely no profit at all. Alright? Now contrast that with if you hadn't waited for confirmation. Well, if you hadn't waited for confirmation and the support zone is around 1410 to 1408.75, let's assume you want to buy one tick above the support zone just to make sure you get filled. Now you can choose. Sometimes you'd want to put your order right in the middle of it. At other times, no, and we'll get into those when we get into the setups, but I'm just talking about general principles here. So you don't wait for confirmation, you're just going to put it at the edge of the zone, okay, with a stop below the zone. So you're entering at 1410.25, one tick higher than the zone, okay, just to get filled, and your stop's at 1408, so your stop is 2.25 points. Well, it doesn't take too much to see that if that were the case and we got this bounce, you easily got your 1-to-1, right? Because 1-to-1 would be 12.5. And even if you were going for your 1.5-to-1 reward to risk, which would be about 3.5 points, you would have still got it because it hit 14, and that would be at 13.75. So in just this one example, we see that waiting for confirmation gave you a complete loss, while not waiting for confirmation, you actually ended up with a decent winner. All right. Now, why is that? Well, the simple fact is that if you wait for confirmation, by default, you have to have a wider stop. And when you have a much wider stop, you need a much wider profit exit just to give you a decent reward to risk to even take that trade. Okay? And when that happens, the ironic thing that happens is that your accuracy actually drops. Now, we've mentioned this before in the training, that accuracy, even though it has to do with entries and knowing which zones to pick that are the good ones, it also greatly has to do with exits. If you remember, we talked about this. And to give you an example, if you're only exiting for half a point at any time, well, the vast majority of the time, you're going to get half a point almost at any level. There's just by the pure noise of the market, you're going to get half a point winners. So you would be very accurate. If you had 2-point stops and you were only looking for half-point winners, you could probably be accurate 90% of the time. Now, that doesn't mean that the strategy is going to make you money. Like we've discussed, you get edge erosion from commissions and slippage and all of that, and you'll end up with a negative edge. It's just not sustainable. That's why you wouldn't do that. But the point is that the exit actually influences the accuracy of any specific setup. And if you're trying to exit for a little amount, you're going to be accurate. And if you're trying to get, many points, you're going to have low accuracy. So again, it's not just the entry that determines the accuracy, it's also the exit of what you choose. And so what ends up happening is when you wait for confirmation, you're degrading your accuracy. It's extremely counterintuitive. On the one hand, it might seem like you're increasing your accuracy because when you wait for confirmation, it's proving that, hey, this is working, right? So you should have higher accuracy. On the other hand, because now you need it to go higher to even exit at a profit, and that's going to happen a less percentage of the time than needing a smaller exit, your accuracy actually degrades. Okay? So just this thing shows you that not waiting for confirmation always gives you a tighter stop, and having a tighter stop means you can have a tighter exit, and having a tighter exit means you're going to be filled on the exit a greater majority of the time. Your accuracy is actually going to be higher. All right, now let's go to the other side of the argument. Okay, someone who thinks waiting for confirmation is a good thing might argue that that even though waiting to get in after this rise degrades accuracy, it's a good thing because it'll also help you avoid the losses where this thing drops and then just keeps dropping right on through here. So the argument would be that if you do wait for confirmation, you would avoid entering a trade that kind of just drops right through this, right, without bouncing, because you only get in when the trigger hits, and the trigger is the bounce. So if this thing comes down and just goes right on through, you would avoid that loss. So their argument is that if you don't wait for confirmation, you're just going to take it automatically here or whatever, and it's just going to go right through, and that'd be a loss, right? Now, once again, this argument does make sense, and here there is a point that yes, sometimes this will happen. But in anything, you have to look at the overall or cumulative effect, not just a percentage of the cases. Okay? And what is the overall cumulative effect? Well, let's think about that for a second. If this is a high probability zone in which there's a good odds of a bounce, and the only reason you should be trading there to begin with is if that's the case. Okay? So if you've determined that this is a high probability zone, and over time and experience you've realized that these kind of trades, this kind of setup will give you 60 or 70% of the time a decent bounce, a tradable bounce, then even though sometimes this thing's just going to go right through it with no bounce at all, that's going to be a minority of the time by definition. And it won't be, if this thing has 70% accuracy, let's say, it's not going to be 30% of the time that it just cuts right through it. Often what will happen is it'll hit it, show this kind of bar as if it's working or confirming, and then tank down, right? And so in reality, it might only cut through it maybe 10-15% of the time straight through with no bounce whatsoever. Okay, so if you wait for confirmation, yes, you do avoid those 10-15% of the time where it just cuts right through the area. Fine. But what about the 70% of the time that not only does it bounce a bit, but it actually has this kind of a tradable reaction? Well, in that case, many of those times waiting for confirmation like we showed will give you a loss instead of an outright winner. And the other times, let's assume this thing just keeps going up a lot. So whether you waited for confirmation or not, both ways you got the winner. Well, regardless, if you don't wait for confirmation, you can get a larger winner than if you do in those instances. Because let's assume you were trading it for a bigger target, let's say for a retest of this high, which is often a typical trade that you would take in certain scenarios. Well, a 2.25 point stop and then a retest of this high gives you about a little over 6 points of profit for 2.25 points of risk, almost 3 to 1. Whereas if you're at 11.5 and you have 3.5 points of risk, a retest of this high doesn't even give you 1.5 to 1. All right, it's only about 4.5 points or so with a 3.5 point risk. So you see, you're going to make less money. And the whole point of my argument here is that since this is a good zone, you are going to be having a negative effect by waiting for confirmation the majority of the time, right? So if this zone holds and gives you a good trade 70% of the time, that good trade is either going to be a loss or a trade with a lower reward to risk if you wait for confirmation. All right? And fine, the other 10, 15, or even 20% of the time, if it cuts right through, yes, you will avoid those. But again, those are only 10, 15, or 20% of the time. So you're benefiting on that minority of the time by waiting for confirmation, but you're really getting screwed on the other 70% of the time where you're going to get losses or lower reward to risk. Now, if you take the cumulative effect of that, it doesn't take a genius mathematician to see that if you're getting hurt 70% of the time and you're only benefiting, 10 to 20% of the time, it's actually hurting you. Okay, and that's what those traders and mostly those teachers that probably don't even trade themselves or aren't profitable, that's what they miss out on when they tell you to wait for confirmation. They point to the times that waiting for confirmation saves you from a loss where it cuts right through. Fine, but what about the other 70% of the time when you're degrading the accuracy and the reward to risk? What about that? What about the cumulative effect? That's what you should be asking. All right? And then the other argument that they'll make is that, okay, since you got this quote unquote confirmation, you could keep your stop small, for instance, by instead of putting it all the way down to 1408, by putting it below this recent little low, right? Because, it's just confirmed, and if it came back down, it would not be confirming. Well, that's another flawed argument, because the reality is that this quote unquote confirmation bar is overrated. What I mean by that is that often what will happen is we won't get just a pure clean bounce right off of here. And now, in this specific example, it seems like it's great. You got this bar and it just foreshadowed this, right? But what'll often happen is something more like this. And let me get rid of this profile so you can see it more clearly. Okay. On this particular day, we were coming to test this support. And this was the gap close, and we were coming down and we hit this support right here. And in this particular day, this would have been a good buy because it wasn't a high conviction down move. It was more of a sideways type day. There was no real directional conviction, and now we were kind of breaking into a support area after a decent sized gap, which will usually give good support. And you'll find rotation here on these types of days. But anyway, we hit it, and what do? We hit it and we balanced for pretty much over half an hour. All right. And you'll see that there were several strong up bars within this, which might have seemed like confirmation. Look at this, for instance. You hit it and two strong up bars in a row. It seemed like confirmation of this low, but what happens? They're reversed instantly. We're back right down to the lows. Right? It happened here too. We hit it, we bounced up, and then we even made new lows. So this is more typical behavior, or at least as typical as this. Okay? And the problem with coming here and saying, well, now just because we got this nice big up bar that we can, put our stop down here, that doesn't make sense for two reasons. One is that you'll get often this type of chop, okay, and it'll just come back down, take you out, and then pop right back up. And two, and more importantly, having your stop here means nothing, because even if it comes down here, as we've seen, that might not be bad behavior. That could just be balancing behavior, right? Going sideways, balancing before it takes off on up. And even if it comes down, breaks this low a bit, and comes back up and breaks it again, but then goes up, that's not a bad thing. The zone is still holding and nothing's invalidated. So at that point, you would be taking a random stop, right? So that argument also, that if you have a nice up bar, you can put the stop here, that doesn't make sense either, because you're just going to get randomly taken out by the noise that'll often happen when it's not this type of scenario, but when you get more of a balancing type scenario, which is very common too. And it's not a bad thing. It's actually a good thing to get balanced here and then break out of it to the upside. Okay? And just as a little side note, I have to make this point because it's a pet peeve of mine, about candles. Now, I know there's a massive amount of literature out there, and so many teachers that talk about reading the candles. Let me give you a little piece of inside information here. I once had a direct talk with probably the leading candlestick guru or teacher in the world. Now, I'm not going to mention names, but you might be able to guess who that is. All right? And I posed the observation to him, because this was my opinion, that intraday candlestick analysis is absolutely meaningless and random. I.e., whether this bar closes at its high or not, or whether it comes back down but then the next bar goes up, all that is meaningless. And the reason why is that, you see, candlestick analysis was invented by the Japanese traders hundreds of years ago. And at that time, when it was invented, there was no such thing as intraday charts. Minute by minute candles weren't kept. They didn't have this kind of real-time technology we do today. They were done on a daily time frame. Okay, so each bar was 1 day. Now, the reason why they work on a daily time frame, and there's meaning behind them, is because the open and the close on a daily time frame are actually a physical open and a close of the exchange. And there's actual significant meaning tied to those, because at the open of the exchange, all right, of the daily bar, you get institutional involvement that's higher than usual. And at the close, the same thing. And often what happens at the close is kind of like the culmination of whether the bulls or bears won or lost that day before the actual exchange closes. But when you're looking at like a 2 minute chart here, my question for you is, what significance is the close of a bar? The exchange isn't closing. What significance is the open? Pretty much nothing. It's a random point in time during the day. And so that's why taking the analysis of the daily time frame candlesticks and putting it intraday is actually meaningless. And this guru that teaches all about this actually agreed with me in a private conversation that yes, intraday, it's really meaningless, but his response was that, hey, traders believe in it, so, we teach it. Well, that's not good enough for me. And the bottom line is, my whole point of this is that even if this is a nice up green bar, yes, that shows immediate strength, but the fact that it closed right here or whatever, in and of itself doesn't mean anything. In and of itself is not a trigger. And it could just as easily rotate right back down and kind of go sideways and build a balance. So you don't want to make any decisions based on this, and you don't want to use these as triggers. I hope all of this has now made sense to you. So now, what's the psychology of not waiting for confirmation? Right? Because it seems counterintuitive. Why is it logical to do it? And how can you think correctly about it so you can do it? Well, the reason why it's logical to do it, other than the fact that we've shown you can get smaller stop sizes, you're going to have actually better accuracy, and the fact that these confirmations sometimes can mean nothing because often you'll have this kind of chop around support or resistance zones. So, waiting for these is actually waiting for randomness. Okay, but other than that, the logic behind it is simply that trading is a game of probabilities. We went through this extensively, very extensively, in the trading framework section. All right, and any great trader, any even good, consistently profitable trader, has learned the intricacies of probabilities and has trained his mind to think in terms of probabilities. And the fact of the matter is, here, we know, based on our experience and based on trading around correct principles of market behavior, we know that the odds of a bounce, all things being equal on this type of day, the odds of a bounce here are high. And that's the whole very basis of the setup. So if we know that the odds of a bounce are high, let's assume they're 60 to 70%, all right, of the time you're going to get a bounce at an area like this on a day like this. Well, what purpose does waiting for confirmation hold? You already know the odds are high. And you know that, 70% of the time this thing's going to bounce from here. So what would be wrong about just taking the trade right there without waiting for confirmation? You see, here's the psychology of it. Waiting for confirmation does not actually increase accuracy like we've shown. The only thing that waiting for confirmation does is gives you a false sense of certainty and security. And that's why most people teach this, because they themselves have not learned to think in probabilities and just take the trade. Right? It gives you a false sense of certainty. Traders want to feel certain. When they see a big bar like this, they go, oh, now of course it's much higher odds that this is going to work, so let me enter. Well, this is a false sense of certainty like we showed here, because so many times even a big bar like this will end up just turning into chop like this. And trust me, this on experience, I can tell you that. Alright, I learned this the hard way through my own career. And so that's why it's a false sense of certainty, because nothing has really become certain. Where in reality, the fact of the matter is that if you know this thing has good odds, you would just think long term. You would think if I took 100 trades like this, 70 of them would work out, so it doesn't matter if this one confirms or not. I'll just take them right there and know that over the long run, over a large number of trades, I'm going to come out ahead. And isn't that enough reason to take the trade? What is the point of waiting for confirmation? You see, when you realize that you don't need to have certainty, that you can think in probabilities, and that it actually makes sense logically and even mathematically, then you realize there's no point of waiting for confirmation. You just take the trade. Sometimes it will be a loss, and sometimes it'll be a winner. And if you're trading the trade in the correct context at a good support or resistance zone based on everything you've learned how to do that, then you will come out ahead over a large number of trades. Simple as that. And so the psychology of this, the way you have to train your mind is to think exactly like that. And you just think, do I have good odds? Is this making sense in terms of the context of the day? Okay, take the trade right as it's slamming into this. Now you got to realize that this is going to seem scary as hell. And let me show you by zooming in just to hear what it would have looked like before the bounce. Okay, here it is right before the bounce. Now look how scary this looks. This thing has been coming down and now slamming in to the support zone on a pretty big down bar. At this point in time, it looks scary to be buying right here. It feels scary. You want to see it bounce instinctually, right? It looks really scary. But the good traders will also realize that because it looks really scary, that means there's panic in the air. That means most traders would not be willing to buy it right here. It would seem too scary for them. They would want certainty. And when most traders can't do something, that's when you have great opportunity. And you have to learn to train your mind to trade against most traders, not with them, because most traders are losing. This is trading against most traders. You buy it right into the support zone when it looks scary, when it looks like the world's going to hell and it's going to break down for sure. Trust me, most of these are going to look like that. Most educators are going to tell you, this is a very bearish bar. You don't want to be buying this. Well, it's not about one bar, like I just said. It's about the overall context. This is a strong support zone. And if you were reading this day and nothing showed you that there's any reason to think that you're going to have a large breakdown, and I'm not going to get into the analysis of this whole day. I'm just showing you one specific example. There's going to be countless of these that you can apply to real world trading. But the point is that I'm showing you that this is what it's going to look like a lot of the time. And you're going to be ready to just condition your mind, if everything you're doing is correct based on context in the zone, to just have your buy order there or just click buy right as it's hitting it. Alright? This is trading against most traders, while this is not. Now you're kind of trying to go with them, waiting for this whole thing. So I hope you've seen all the drawbacks of waiting for confirmation, all the benefits of not waiting confirmation, and the real logic behind it and how it fits in with everything we've been teaching so far. This isn't just a random thing, right? And I'll tell you that any trader worth his or her weight knows this concept, understands, like we taught in the initial session about strategy, that not waiting for confirmation is what's going to give you the best trade location. And trade location is the thing that we talked about that is a requirement for a strategy with an edge. The more you wait for confirmation, the worse your trade location gets. Now, there are some good trading educators that also happen to trade their own money that do teach this, but since the majority don't actually really trade or don't actually know how to trade and make money consistently, they teach wrong concepts. And we'll revisit this concept when we talk about jumping on board trending moves, because in that case, you're actually going with momentum. You're not fading a zone. But even then, I'll show you how you're not actually waiting for confirmation. And I'll explain that to you from the context of getting on board trending moves. But for now, we're talking about support and resistance zones, and I hope you've understood the concept well.